In this example video, we're going to look at review exercise 15-2, which is dealing with something called stock subscriptions. So it tells us that the Hart Corporation entered into a subscription contract with several subscribers. The contract requires the subscribers to purchase 2,000 shares of $4 par common stock at a price of $20 per share. The contract requires a down payment of $5 per share, with the remaining $15 per share collectible at the end of 1 month. The stock will be issued to each subscriber upon full payment, and they want us to journalize the entry to record this transaction. So what's happening is we are making an agreement to sell 2,000 shares of our common stock at a set price. So even if the stock fluctuates and goes down to $15 per share or up to $30 per share, it doesn't matter. Those 2,000 shares are locked in to be sold at $20 per share. So we have to kind of segregate those shares out because we can't sell them to anybody else during that time frame because we do have a contract to sell them. So when we sell them, it requires a down payment. So it says that we required those subscribers to give us $5 for each share of stock that they intend to purchase from us. So we're going to collect $10,000 from them for that down payment. That $10,000 might be able to be refundable or not. So if for some reason one of the subscribers decides that they don't want to go ahead and continue and not pay us the other $15 per share, it's possible that we as the company get to keep that money, or if it's listed in the contract that it has to be refundable, we could actually refund that as well. We also have a receivable. We have a subscription receivable for that common stock. So again, we're waiting to receive that other $15 per share, and there's 2,000 shares that we're going to be getting. So in the future, we're going to be receiving $30,000 more for these subscription contracts that we have. Again, we have to segregate out. So when we do our balance sheet presentation, we have to show that these shares of common stock are not part of the lump sum common stock at this point. They're subscribed, so they're kind of being held in their own spot here. So we have our common stock subscribed. Again, only can ever go on our books at par value, because when it comes off our books, it's going to come off our books at par value, because what we are going to in fact issue once they pay us that additional $15 per share is common stock. And the difference goes to our other equity account called additional paid in capital on our common stock. And it's simply the difference between the cash that we are going to be receiving in total for these shares, so $40,000 in total. $8,000 is being put towards common stock, so that means we have $32,000 in additional paid in capital on our common stock.